Momentum will usually, almost always, I'd say 90% of the time, will break its trend first and warn you that, hey, what you see on price is lag to reality.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Michael Oliver, founder of Momentum Structural Analysis, is a leading expert in financial market trends. Known for his momentum-based analysis, he identifies key market shifts across commodities and equities. With decades of experience, we'll be picking his brain and asking the questions you submitted. Michael, thank you for coming on the show.
Good to be here, Steve.
Well, the pleasure's all on this side of the table, sir. This being your first time on the show, let's start out with your story, how you got into investing and how that led to where you are today.
Well, when I was in my early 20s, I joined E.F. Hutton. I quit a PhD program in political philosophy in 74. This is a great global stagflation. You remember, and given my political bias, which was libertarian, I knew I wasn't going to get a job probably, and universities weren't hiring. A friend of mine said, hey, come on in, the water's fine. He'd just joined Merrill Lynch as a commodity broker. Well, I applied to E.F. Hutton's headquarters in New York and moved up there in April, a couple months after gold was legalized in January of that year. And it happened that the head of that international commodity division of Hutton's commodity division in New York was also chairman of the COMEX, which is where silver and gold started trading that year. Silver had been around a while, copper as well. Anyway, so I was a futures broker, and I didn't know diddly about technical analysis. I knew fundamentals of gold, but I didn't really know, the stuff you need to know. And he was basically a simple price chart technician, and he showed me, hand-drawn charts, how to draw trend lines and things of that sort. And that's the way I started. But I stayed a futures broker till 92. But in 87, I was an independent futures broker, and I happened to catch the crash in 87. Now, I didn't catch it in a major way. I didn't make millions of dollars, but, I did catch the move. And so did my clients. And what we did, we bought puts prior to that October crash, because I had certain technicals I was working on then that told me there was crash potential, or there was major downside potential, put it that way. And it wasn't evident at all on a price chart. You could plot a price chart and it just looked fine. Hey, you're having a little dip in September, no big deal. But as soon as you opened October, it was like they pulled the floor out from under it. Well, what had happened is when you plot the price action of the S&P then, you see one picture, which makes you feel happy. But when you plot it on a quarterly momentum oscillator, where you take each monthly bar, for example, and plot it in its relationship to a 3-quarter moving average, which adjusts up every quarter or adjusts down depending on the market. Well, in this case, of course, that 3-quarter average is adjusting up because the market was going up, right? Okay. But when you plot the oscillator, you didn't see what you saw in the price chart. What you saw was a market that for 2 years kept coming down to a flatline structure. Kept coming down to a...
So it was generally working its way down.
In other words, the oscillator had a floor under it. Price didn't. Price was upward curvature. So price chart looked good. Momentum said, boy, you better not break that floor. Well, as soon as you rolled into the next quarter, the fourth quarter of 87, September had already wobbled just a bit off the high, not a lot. And you'd made your high in August, September of that year, by the way. And you wobbled just enough off that high so when you opened the next quarter, early October, and you adjusted that 3-quarter moving average up, then the oscillator reading started to drop. Why? Because moving average was catching up to the market. Okay. And boom, you broke that structure. 2 weeks later, you had a 35% crash, just like 29, same dimension. Couple weeks, 35% crash. That's basically what a crash is, 30 to 35% in a matter of a couple of weeks. They're rare. Now, but that structure, we have similar structures right now on the S&P 500, the NASDAQ 100, the Sensex index in India, the Nikkei 225 in Japan. In other words, we have it in too many places. It's telling us, MSA, forget the price charts. They're sometimes illusory. And usually when you get a major trend in a market, whether it's a crash or a bottom or whatever, or just a downturn even, Momentum will usually, almost always, I'd say 90% of the time, will break its trend first and warn you that, hey, what you see on price is lag to reality. And then suddenly, when the momentum breaks, shortly thereafter, the price will follow it down or follow it up. And right now, we're in that kind of position where when we get into next quarter, which is what, 6-7 trading days away, all of a sudden, these numbers are going to shift. And you've got several bubble markets around the world, bubble stock markets. But by bubble, I mean, protracted time on the upside, massive multiple move since the bear market low in 2009, more so than any time in U.S. stock market history. This doesn't compare to the 29 bubble top. It doesn't compare to the .com, the bubble top, or the 2007 real estate top. Everything they followed by what we call them, they were bubbles. That's what people look back and call. We've got a bigger bubble now, far bigger. Duration and distortion. And, some people like to say, well, it's because the economy's been strong. Okay, well, look at a Fed funds chart. Go back 50 years or so. See what rates were that they fixed, artificial from above control over rates, okay?
Yeah, it was 15 to 19% or something, right?
Yeah. Well, normally you're up there in the double digits, swinging back and forth and so on. But when 2008 hit, they started cutting in 2007, by the way, right at the top. They cut at the top. And did it help the stock market? Absolutely not. They collapsed rates to zero, by 2009-10, and the market collapsed 50% anyway, and the mortgage market imploded. It didn't help. Same with the .com top. Fed cut rates, and in fact, it was the rotation of a new president, and they cut it twice in January of 2001. 2 rate cuts in 1 month, okay? And we were only marginally off the .com highs. The market really hadn't started to implode at that point. So it wasn't like everybody was screaming bear market, but they cut rates. They cut them all the way down through 2002 and 3. Did it help the market? No. NASDAQ 100 dropped 82%. So they cut rates all they want and won't help once the bubble breaks. And I think we're facing that right now based on our technical work. And I think the little wobble we saw yesterday, of course, a lot of people think it was a jaw-breaking wobble, but all we need to see is that wobble basically hang around here through the end of the year, the next 6-7 days, up, down, up, down. It doesn't have to collapse. And if you're hanging around these levels or just a bit lower, you're going to open next quarter at the gate of hell. Okay. Now, it doesn't have to crash. No, just because you have a structure that's breaking on momentum. If you saw it, and we have them in our reports, we're not looking at it today, but in our regular subscriber reports, we show these structures. You break those structures, you could go down, and probably fairly sharply initially. And I don't mean you have to crash, but a lot of people even now are saying what? We need a correction. A lot of sober analysts out there. Well, what's a correction? 20%? You can't drop 1% or 2 because you're going to go that 20%. When you go the 20%, ultimately you're on your way down to a lot lower levels. So that's the major reality that we're facing right now.
Okay. Well, you were in warm company with a group of libertarians, sir. So welcome. All right. So you got your start, cut your teeth back when gold and silver were coming onto the COMEX. I mean, you've been in this a long time.
Yeah.
And you see some similarities now to what you called back in 87 of a big market correction or crash. You see some similarities today that
distinct similarities. Yes, very distinct. Yeah, overlays almost. Anyway. Yeah.
Okay. All right. We've got a healthy portion of cash in the portfolio right now, around 25%. Do you think that's prudent, or is that a little on the shy side, or what are your thoughts there?
Well, it depends on where the other is. It's 75%. There's times just not to be there. You don't have to be short the stock market, but just say, hey, I've had a great time, especially if you got in at more optimal levels. We got major bullish in March of 2009 when it was, in fact, 2 weeks before it made the low. We said probably around 670. It went to 666. And we said, this is a major low. And no, we didn't know it'd last for 15 bloody years. No, of course not, And it had its breaks, ups and downs, and we called some of those. And frankly, it's been a lot longer than we expected. And while much of the market really peaked in 2022, like you'd look at small caps or a lot of sectors even never exceeded that high or only marginally did. But the S&P and the NASDAQ did, took out the 2022 highs. But it was largely at that point onward a leadership function of, half a dozen stocks. And everybody knows the Magnificent Seven or whatever they want to call it. But most of them, were in the NASDAQ 100, front-end loaded, heavily weighted symbols, such as, 5 or 6 symbols basically were 50% of the entire index. And for the S&P, the same 5 or 6 symbols were about 30% of the index. So that's where the action was. It wasn't really breadth. And it persisted. And a fever came. And I'd say the fever particularly has been noticeable in the last quarter or so, but especially once Trump got elected.
Yeah.
There was a buying orgy by the Trumpers who thought, well, reality's going to change now, and things are going to go toward capitalism, supposedly, and less government and all that stuff. And well, maybe and maybe not. But the point is, our point is that the reality is that there's a bubble there. You've had 15 years of distortion of price, and especially the cost of money. And when people have that distortion in their economic decision making, the cost of money, it's an essential factor. If it's artificially low for 10 of the last 15 years, then you make decisions based on that. You commit money, you borrow money, you lend money based on premises that are not sustainable. And so when all of a sudden things start to get shaken and those errors start to get exposed, I'm talking real world now, then the hemorrhaging begins. And part of that hemorrhaging will show up in the areas where it's most distorted, and that would be the stock market, for one example. Not commodities. Commodities are still very low historically. They've had ups and so forth, but they're still historically low. So the real distortion was in the stock market, which is quite typical. And when it comes unwound, the central bank can change policy all they want, but it doesn't work. Never has. It does help something else, though. Monetary metals.
I just had the market sniper Francis Hunt on, and he pointed out something that was interesting. I saw it as well, and then he kind of confirmed it in my head, in that the Fed just cut 25 basis points, and the benchmark for the cost of money, I think, is the U.S. 10-year Treasury, and the yield on that went up. And maybe you can pontificate on this a little bit. I literally sold what middling intermediate bonds I had yesterday. After that, I'm like, okay, this isn't playing out like I thought it would. Maybe give us your thoughts on that.
What I started MSA, but I didn't finish that first topic. In '87, after the crash, in '92, we started MSA. And our clients up through 2015 were only institutional. Then we opened up to retail. But we've examined bonds all during that time. MSA looks at 4 categories: the interest rate markets, equity markets, not just ours, by the way, other equity markets, commodities broadly, especially the metals, monetary metals, and foreign exchange. Well, the bond market you're talking about here, the long end of the bond market, not the end that the Fed plays with, which is the short-term nonsense. But that 10-year, especially the 30-year, those T-bond futures have been around for a couple of decades now. They don't behave like the Fed rate cuts. You go back to September when they cut rates the first time, 0.5 point. Stock market rally, bonds sold off. Yields went up, not just the 30-year, but the 10-year. And then they cut them again the other day and then went down again. Price went down, yields went up. So, they're not in charge of that end of the market at all. Why? Because that end of the market's so huge that they can't play with that so much. They like to try to influence it. And right now it's got a stranglehold on reality. because rates have stayed high since late 2022 on the long end of the debt market. If you look at a 30-year yield chart or a 10-year, or look at the price, they're in the hole and they just don't come out of the hole. Technically, here's what MSA thinks. Normally, when the stock market peaks, you go back to 2000, 2002, 2007 to 2009, bonds are a place to be. Money moves into gold and into T-bonds. Gold and T-bonds performed very well as the stock market peaked in 2000, 2007. For the next couple of years, gold went up, bonds went up. In fact, gold went up through 2011. But during those times, those two were the alternatives. So why aren't, well, our assumption is, and this is just broad based on that knowledge, when the stock market does begin to crack, especially by our metrics, the T-bonds will start to firm in price, drop in yields. Not because the Fed cut rates. It has nothing to do with that. We're talking long end. No, the long-term trend in T-bonds is negative, meaning higher yields, lower price. But even in a major trend, you can have a counter trend move. Markets inhale and exhale. The technicals for bonds look poised that once the stock market fractures itself, it initially, it doesn't have to crash, just it starts to break 5% off the high, 10%. You'll see the T-bonds being pursued by asset managers who are looking for a place to be that is better in their perception than high risk, low reward stock market. And there's plenty of asset managers out there who've expressed doubts about the stock market based on, the long-term fundamental type metrics and assumptions. And they're right. It is distorted. It is way off the page. But the issue is the timing. But when you start to see that market crack, our bet is that the technicals that we see, the momentum technicals in T-bonds, could spark a sharp rally, a drop in yields. And not because the Fed's doing something. No, it's because people are seeking an alternative, a place to be. It might be shelter. And the other place they're looking is gold and silver. And people don't realize it, but gold's up more on the year than the S&P. Nobody's cheering it, though. It's up more % year to date than the S&P. Anyway, that'll be the other alternative. So that's why we're focused on the stock market, because when it does crack, money's going to flow.
Okay. So long term, you see the yields of bonds going up, meaning the value will go down.
And next year, yeah.
Yeah, short term here, we could have some little flips in tradable opportunities.
Maybe over a quarter or two, you could have a sharp rally in T-bonds, which is merely a panic buying of bonds.
Yeah.
As an alternative. And, one, they're cheap. And if you look at even a price chart, they're really not going down since 2022. They're just not going up. Yields aren't rising anymore. They're just not going higher, but they're not going lower yet. And the technicals look ripe for a spike, drop in yields, sharp rally in price in T-bonds, and it will likely, highly likely, be coordinated with a break in the stock market. In fact, if you just punch up a weekly price chart of the S&P, go back to August, September, and see what it's done, and then look at the same chart of weekly T-bond futures. Opposites, total opposites. And that will reverse the other way when the stock market stumbles.
Okay. All right. We got some questions on gold here. Burren wants to know, he says, the recent drop in the stock market pulled gold and silver down with it. Everything except the DXY was down. Do you still see precious metals to go higher when the stock market crashes?
Yeah. You can ignore the daily similarities which occur from time to time. And there are times when it does occur. One time it didn't occur recently, for example, was when Trump got elected, the day after. It was an orgy of buying in the stock market and an orgy of selling in gold. So, his comment is true. Yes, the other day we had a similar drop, but look at what happened after the election. Gold dropped down to $2,540. Right now it's $2,650, by the way. It's well above that sell gold orgy after the election. In fact, it's above the levels it was prior to that orgy beginning. And the S&P right now, by the way, is back below the levels where its buying orgy began after the election. So don't look at the day-to-day. It's nonsense. Look at the bigger picture. And even in that regard, the panic selling that occurred that November 6th and 7th on gold and buying when the stocks was totally opposite and quite significant. But it didn't last. They've started to go back this way, okay? So I would ignore the day-to-day. Look at the bigger picture. And if you go back 100 years, 100 plus years, we just put out a report on this the other day. My son penned it. It was, where do you, a long-term investor, let's say somebody who's thinking 10, 20 years out, to park his portfolio. Stock market, it's ever up, right? No, it isn't. If you go back and examine carefully, there's many times, like 4 major times at least, where you'll have a major top in the market, a sharp drop, 28.9 to 32, for example. But it takes years to get back to the price level you saw prior to the drop. Oh, yeah, there's an upturn. But when you also factor in the ongoing decay in the real value of the money because of the increase in the money supply that occurs decade by decade, almost doubles every decade, then let's take NASDAQ 100, for example, 2000 dot-com top, it collapsed 82%. Well, if you didn't get out then, and we did say sell in January 2000. Now, it took a year before it really started down. But if you didn't get out in 2000, it took till 2016 to nominally get price back to where it was in 2000 for the NASDAQ 100. 16 years.
There we go. So 2000, and this is what you're talking about. If you just
the price of the NASDAQ, but it was 2016 until you eclipsed that price. But you had to factor in 15 to 16 years, there was an ongoing decay in the real buying power of the dollar. So this thing's quoted in dollars, right? Okay.
Yeah.
So, yeah, it made a new high in 2016 nominally. But in reality, in real spending terms, if you converted that to spendable money, you weren't back to even then even.
Yeah.
Now, for the S&P, when it peaked in 2000 at 1,550 or so in price, it did come back to it in 2007, again to 1,550 level, nipped it out by 20 points, and it collapsed again into 2009. It wasn't until 2013 that the S&P finally got above the 2000 high, and look at the number of years spent there.
Yeah.
Sticking your teeth, meaning if you're a long-term investor, you didn't make any money in that 15 years.
Yeah.
And it took a lot longer to make real money, factoring in the fact that money value declines 50% every decade because the money supply doubles basically every decade. Okay. Well, during these periods of time, if you go back and look at the 29 to 32, which didn't come back to the price high till the 1950s, okay, what happened? What served you well during that period? Gold wasn't traded then. It'd been banned, okay, for domestic, Nixon did that later on international, but it was banned. Home stake mining went up 1,000%, while the stock market declined all during those, stayed depressed. Home stake mining, biggest gold miner then, later got bought by Barrick, I think, in this century. It went up 1,000%. So now, and you go back to 2000, as we showed 2000 to 2015 there on the NASDAQ before it could get back to its high again. What went up during that period? Well, from 2000 to 2011, gold went from, $260 to $1,920. Yeah, there were ebbs and flows, but it was, from an investor's point of view, it was a hell of a great place to be. Okay? And even since gold made its low, in fact, I sent you a chart if you've got it.
Yeah, I'll pull that up right now.
We're looking at gold miners now, which is everybody thinks is the dog, right? Okay, and it is relative to gold. It's been behaving like a lagged little dog. Okay, now what we're looking at here, is a report we sent out today. This is a spread chart. It's a spread chart. What we do is, the end of each month, we take the price of the XAU index, which has been around since the 1980s, and we like using it because, one, it's not traded. Like, GDX or some other things are traded, and therefore there's a little more motion in them. But it measures the price of gold and silver miners combined. It's called the Philadelphia Gold Silver Index, but it's actually miners. But back in the peak in 2010 and 11, when XAU was expressed as a percentage of the price of the S&P, this chart was up at 18%. Okay, meaning
Okay, so just like a few clicks off the left side.
and there was
it's
just
up to
10% there, but it was actually up at 18%. It collapsed in relative performance to the stock market, all the way down to 2.2% by December of 2015. That happened to coincide with when gold and the miners actually made their price low. But they also made a relative performance low to the S&P. Okay, now think about that. Gold then was $1,000, 1,050, and XAU had hit a price low as well at $45. Okay, now coming up off that low, as you recall, that we issued a major annual. We were bearish during the bear market in gold. We got bearish late 2011. We got bullish in February 2016 based on annual momentum. But when you look here at the relative performance chart, which is simply price versus price, okay, so it's not a momentum chart. It's measuring the price of XAU expressed as a percent of the price S&P. It got down to like 2.2% there in December. A couple of months later, we gave our buy signal, but sure enough, the spread also exploded. Why? Because the XAU index exploded in price, and the S&P wasn't. Okay.
Yeah.
The XAU went from like 2.2% to 5%. It doubled in relative value compared to the S&P. That was coincident with a big rally in gold and silver then, too. Remember, gold went from 1,050 up to 1,350 during that same like 6-month period.
Yeah.
It was an exhale. We're off the low. Okay, fine. Now look what's happened in 10 years. It's exactly 10 years. This is December 2024, so it's 10 full years since the close of 2015. Okay. And you've had ebbs and flows in performance by the gold miners versus S&P. But it keeps coming back down to this 2-point-something%. But you think, well, that's a dog. Well, actually, it's not. What it means is that relative to the S&P, the black arrow there, gold miners haven't lost any value to the S&P since they made their bear market price low in 2015. Yet they keep coming back to that same relative level, but they also produce nice recoveries in between. But basically, they've been par performers to the S&P for a decade. Now, you tell somebody that in a bar, they'll chuckle and drop their drink to say, hey, I went long gold miners in December, early 2016 or December 15, and I'm making just as much money as you are along the S&P. They'll laugh at you.
Yeah.
Actually, point of fact is XAU index, as of just before we put this report out earlier this morning, was up 211% in price versus its low close in 2015. S&P, same time period, up 191%. Actually less than GDX in that 10-year period. And yet nobody knows that. All they're focused on is not the ebbs and flows, but the flows that go down in GDX or XAU and the miners drop. But net on balance, since things really turned up in early 2016 by annual momentum metrics that we put out.
So
By buying it holding, you've done quite well, you know.
yeah. So this chart here is basically taking the price of the XAU, which is gold and silver miners, and then dividing that by the S&P 500, which gives us
dividing it into the S&P 500. Yeah.
giving us this this ratio here. And you're saying as this goes up, like right now we're at 2.42%.
Yeah, that's right.
Once it gets up to 2.8%, that's when you'll consider it a breakout.
Yeah, in other words, this spread, whenever those green lines have been crossed, wow, the spread, and you get an explosion in the performance.
Yeah.
They happen to correspond to an explosion in price.
Okay.
And for instance, the second trend line there broke out, and after 2019, we made lows in late 2018. Spread came back to its low. Price did not, by the way.
Yeah.
Price of gold and the miners came back down, but didn't go back to the 2000. But the spread came back down there. But then shortly thereafter, in early 2019, and we know there was a big surge in price in mid 2020.
Mm-hmm.
The miners exploded, gold exploded, silver exploded from, early 2020 to mid 2020. And this spread did too. But look at the trend line we have now, the third trend line.
Yeah.
All you got to do is go up to 2.8%. I'm going to blow that structure out.
Yeah.
Now, this is not probably a leading indicator. This is probably going to lag a little bit. But we think the key now to get gold, silver, and the miners into really vertical mode is a combination of, one, them behaving well. And we'll look at that silver chart in a minute, which is, of course, silver's like the miners. It's the dog compared to gold. They sell off more, they go up more, than they sell off more, so they're a little wilder and disappointing to everybody who gets in late, especially. But we think that the fracturing of the stock market that we see pending is likely to correspond with that spread breakout that will assist in the miners by holding around and gold hanging around and not collapsing with the stock market, which it won't. It's our argument, despite the last couple of days. You'll see gold and the miners hang in there steady, yawning, up, down, up, down. When the stock market fractures its structure, you'll see that spread breakout.
Okay.
In which case, the miners will re-engage. And our argument is likely we're going to drive that spread much higher than you see on that chart. No, not back to the levels you saw in 2010 and so forth, which is way up there, up in the 20s and 30% level, by the way. But probably back up this, we see a target of about 17%. Jeez.
Wow.
8 to 17, that's like buying a stock at $2.80 and having it go to 17.
Yeah.
That's what that spread we think is likely to do. But it will also be an expression of the price behavior of the miners and gold and silver, not just going up in their arm wrestling manner that they've done since early this year. I mean, they're up at 25, 30, 28%, gold and silver. Okay. Hard to believe, right? Okay. But go up in a more vertical manner. And that spread will also express that.
Okay. I track another one. I haven't seen this one before. That's pretty cool. But I divide, what is it? Gold by the S&P 500. I guess kind of a similar one. You're just taking the commodity.
It's a similar thing. In fact, gold is far further off of that 2015 spread low than the miners are, but still doing quite well. Okay. But anyway, so they both look similar.
Yeah.
Where, it really, you say, well, gold's a dog compared to the S&P. Well, not since 2015. It isn't. And you measure it in reality, it's not. Okay. And it has its ebbs and flows. Where it underperforms for several months, just like that spread chart, you can see the ebbs and flows. But it's really it's gone lateral, meaning par. Yeah. So right now we're in a downswing because the recent S&P strength we saw the last several months, gold stalled a bit, right? But overall it's been hanging in there, and people don't realize that. The question is, well, why would the monetary metals hang in there? We don't have any rampant inflation, right? Well, gold anticipates events. It doesn't wait on data points like a lot of people think. And I think it knows what's coming, because when that stock market bubble breaks, you're going to have repercussions in policy around the world that will curl your hair. In terms of central banks going berserk. Not just ours, but others,
Yeah. Okay. I think we answered Peter's question there, and Thomas. Okay. Cam and Andy have a similar question. Mike, great job. Thank you for your work. What are your favorite miners to hold and buy? Junior, larger producers, gold miners, silver miners. What are your thoughts?
Well, we argue that in the latter parts, and this is true if you go back into history and look like a 75 bull run, what silver did. Look at what happened in 78, 79, and 80, silver versus gold. Look what happened in the latter part of the 2000 to 2011 move in gold. Look what silver did in the last year or two. It went off the page compared to gold. So there's in the latter phase when price starts to move instead of like arm wrestling up, you go into more vertical moves like we did in 1979, for example, where, gold went up in many multiples, silver went up far more.
Yep.
When you get into that phase where the buying becomes orgiastic, okay, you'll see silver vastly outpace gold. So it's our argument that once you break the stock market and the money starts to flow into the alternatives, and as we've said, last 10 years, gold and miners have done pretty well versus the S&P, though nobody knows it. Wait till they re-engage, okay? When the money starts to flow more emotionally, not by gold bugs, because, the gold miners the last few years, it's the gold bug phenomenon. The public here in the U.S. is not at all excited about gold. They may be in China and certain parts of the world and India, for example, a lot of foreign buying of gold. But nobody over here cares about it. Everybody's focused on the bubble, stock market. It's a party, okay? But once that party breaks, then suddenly smart money is going to say, well, what's been doing good? Where's a safer place to be? It's when the regular investor starts to move out of his scared retirement fund and move some of that money into gold miners and silver miners. That's when you're going to see the gold and silver miners really engage. Because these people, generally, they don't go out and buy bullion and futures contracts on gold and triple long ETFs on silver. They buy miners. They're looking for some dividends. The earnings are pretty good in some of these miners, by the way, percent-wise. And so they'll shift money into this lower risk, higher reward potential category. And that's when you'll see this very small little sector get goosed. Our argument is not only will it get goosed versus gold, the miners, and right now they're laggards, clearly. Okay, gold's well above the 2020 price highs. Miners are still capped below the 2020 price highs. But that will change. And what will change that is not just gold going up, but money flowing out of the stock market. And at that point, we prefer the silver miners over gold miners. Perhaps not at this moment, but soon that will be the case. And as far as the juniors versus the biggies, the juniors will become attractive once more money flows into the mining sector. When people start looking for cheap, they may not understand the fundamentals of this miner versus that, but they like cheap and they can buy more quantity. Sort of a stupid argument, but it works. It works in the U.S. stock market. We know that. When all of a sudden they get grabby. And I think that's the point when also the bigger miners will start buying up the smaller miners. But right now, the juniors are going to lag. And there'll be a point at which they suddenly jerk into a new reality. That probably won't be at the outset. That's probably going to be after we start to see more verticality. And then it'll be time to look at the juniors. As far as which miners we prefer, we run a monthly report, a spread relationship report, like that chart we showed of XAU versus S&P. We measure specific miners, components of the GDX, for example, which include silver miners, by the way, they're in there, and run them on a spread basis versus GDX. And it's always true in any stock market sector. I don't care what you're looking at, internet, healthcare, doesn't matter. There's always going to be stocks that perform better than the index and stocks that underperform. And often these will rotate and won't stay constant. Let's say you have a 5-year bull trend. Well, the outperformer this year may not be the outperformer in the latter part. So we measure them month to month on a spread basis and say, okay, these are some outperformers that we'd favor. So if you want to get more selective, rather than like buying GDX, for example, you want to buy, let's say, 6 of the outperformers to try to beat the GDX. We offer our view on that. And it shifts over time because things change. So that's how we look at that issue.
Okay, so generally speaking, the way these commodities cycle run, you know better than I, but basically the commodity itself moves first, which gold has had an amazing run from its triple bottom at 1615 all the way up to 2800. That was awesome. Then we had a little spike in the majors. We had basically a double in the majors from February until a couple months ago. But now they've come back down. So you don't really feel like the juniors are quite the place yet. We still got some time to play in the majors here.
Well, I think it could move quickly.
Okay.
I don't think it's going to be an arm wrestling. It's been arm wrestling upside since earlier this year. Like I said, gold's up 28% on the year right now. I think S&P's up less than that. But nobody notices that because all the ebbs and flows and the downticks disturb everybody. And they're all feverish on the stock market. So they're blind to the reality. But the point at which gold will no longer go up 3 steps and pull back 1, and silver go up 4 and pull back 2, that'll shift into something more like gold goes up 8 steps and pulls back 1. Silver goes up 10, pulls back 2. That tonal change is going to occur once you move the money out of the bubble.
Okay.
That means, so if you're long gold and silver, yeah, watch them. And frankly, we'll look at a silver chart and they're in an upward bias. It's just a fact. Unless you bought high at a stupid place, you're doing well. Like early this year, we had put out a buy signal in March. We said, we're going to get a move out of this stupid range we've been in. And at that point in time, for example, we had an annual momentum chart of silver that had a structure. Couldn't see it on the price chart because, silver went up to 30 a couple times, 2020, 2021.
There we go.
It kept making highs in the 26s. Yeah, here's a silver price chart now. Its price peaks back in 2020 and 2021 were like the high monthly close there circled on the left. The first circle is like 28.90.
Yeah.
And then you actually traded over 30 intra-month, but most of your closes were like in the upper 20s. These are monthly closes.
Yeah, 28, 27.
Yeah,
Yeah.
20, yeah. You had a brief spike above 30, but basically your resistance was up in the 28, 29 zone. Okay. And while gold went sideways mostly for the next couple of years, silver went into a staircase.
Yeah.
Underperformed gold, the dog. Okay. Dog on a leash though. But then starting in late 2023, you actually emerged above what we call a parallel channel, which is one of the very few price chart tools we use. Normal trend lines on price we think are BS most of the time. But parallel channels, in this case, we took the 2 low monthly closes during that period, plotted a line through them, and then we projected a channel top through most of the highs that you see there. We could have drawn it a little bit higher than that, but we were in a channel. Okay, you ate your way through it in late 2023. You didn't explode, but you ate your way out above it. But you'll notice, look at all the high closes there, 25 plus, 25 plus, 25 plus. There was another ceiling.
Yeah, these are clear breakouts of this parallel.
You're above the channel, and price-wise, not looking at that channel, you were capped. If you go back in late 2022, you'll see there's a rally high close just above 25 also. Yeah, right about where you got the arrow. Now go a little left. No, that's just above 25. The high close. And you look at all the high closes since then, monthly closes, 25 plus, 25 plus, 20. It got boring.
Yeah.
Well, early this year, when you moved up above 25 plus, we not only were challenging that price level, we were challenging an annual momentum structure that went back a couple years. And we blew it out between 25 and 26 in price. What did silver do? Recently saw 35.
Yeah.
Good move, okay? It's still, though, in an arm wrestling process. You'll make a surge, then you'll pull back. They sell it, sell it, sell it. Does it do any good? You decide. Look at the red horizontal. They sold the heck out of it for 4 months after that May surge. It couldn't get back below that level on a close. Then we surged to 35. Now it's been 3 months of selling again. Where are you at $30 today? Okay. Yeah, it's off the high. But what's the bias of this chart? Up.
Up.
Right? It's up. And you say, well, this massive, disastrous sell-off we just had, is it disastrous? You decide. Yeah, if you bought at 35, it's disastrous. But that wasn't the optimal entry point. Anyway, so even price chart is in this arm wrestling process. And what we're arguing is when you break that stock market, when the money flows into this beast here, you're not going to get this arm wrestling stuff anymore. You're going to get more vertical action.
Okay. What is there any? I like to pay attention to monthly, quarterly, annual closes. Is there a number you have in mind for silver here? And I'll throw gold in there as well as having a quarterly and annual close. That
no, they've already achieved that back in March, and so we're in already momentum is positive having zigzags, but the annual momentum using a 36-month average of silver, that price chart had this minor ceiling at 25, 26 level. But you go back on that annual oscillator that we issued back early this year when we showed warning of the breakout 25, 26 zone, was massive, more massive than even that price chart thing. And so we're well above it. So the only thing we're looking at now are more intermediate type metrics. Like we run a 50-day oscillator of silver and 100-day and stuff like that. And we'll argue this. If it takes getting back to 35 to convince you that everything's still okay, get back to the high. What's it? You get above 33, you better watch out. Okay, so that's sort of in the middle of nowhere if you look at that price chart.
Yeah.
But get back over 33 in the next, couple weeks or a month, they're going to blow those highs out. And you're probably in the acceleration, the more vertical phase. We had originally thought that might occur prior to the election. It did not. But we're still right on our assumption that in March, if you weren't already in silver, you should have bought it at 25, 26 zone. And for gold, that zone was between 2,000, 2,100 on annual momentum. And it was again coming back up to what? It had been above 2,000 3 times prior to that. So it was coming up a 4th time. We said this time it's different. So again, we think the acceleration phase will occur. We need that other asset category to crack. And I think we're on the verge of that.
Okay. What do you see? Okay, so in the silver chart, we all know it's tapped that $50 mark, although sometimes intraday, we've hit it 3 times.
Geez, yeah, a couple times, yeah.
Yeah. Do you feel like the next time is a charm, or is that the time where it's like, okay, sell almost every silver miner we have, there'll probably be a pullback and then we can get back in later? What are your thoughts on that?
This is going to be different this time. That's an idiot price chart level, okay? In other words, any idiot with a price chart look like, hey, you hit 50 there, hit 50 there, I'm going to sell at 50. Okay, fine. You can do that if you want. Our bet is when you get through this phase we're in right now and you clear that stupid 35 level, which is meaningless, really, not even meaningful on a price chart. It's not even meaningful in momentum. It's just a round number they picked, okay? You get through that level and we're going into the acceleration phase. $50 will be blown out. And, I've got some biases, but they're not hard noodle. They're wet noodle biases where that first surge might carry, but demonstrably beyond 50 before it even pauses. In other words, anybody who thinks that might be some kind of pivotal level and they're not going to get committed to believing in it until it clears it, well, it's going to clear it the next time. You're not going to arm wrestle your way up there all the way. You're not going to go up 5, pull back 3, you go up 5. There's a point at which you'll go zapping through that level. And again, I argue that is likely when this next upturn occurs, especially when that upturn occurs and money starts to flow. Because remember, the money flow out of the stock market will be massive. That category is huge. It doesn't take much money flow out of that to blow the monetary metals through the roof in terms of dollar volume, okay? And that is likely to occur in a matter of weeks, months, not years, okay? And when that occurs, you'll start to go vertical. And I've made this point before about $8,000 gold. People say, oh, you predicted $8,000. Yeah, ultimately, it's a silly number, and I'll tell you why. If you go back in the history of gold bull market since it was legalized, there have been a couple 8-fold plus moves, okay? Let's take the 2000 to 2011 move. You went from about $260 to 1,920. Okay, about 8-fold move. Okay, the prior peak in 1980 was like an 8-fold move from even the correction low in 76. You went from just above 100 to 850. Okay, hey, it's no big deal to have an 8-fold move. You've done it twice. 1976 low, correction low. After you hit 200, you went back to 100. And 2000, 2011. So you've done it twice. You look at a log scale chart, you'll see, same dimension move. Well, if gold were to replicate that from bare low 1,050 in 2015, it'd be over $8,000. So is that some kind of scientific prediction? No, it's simply noticing, hey, you've done this twice before. It's no big deal to do it again. particularly given the dynamics that are in play this time as opposed to then, in terms of causing massive damage in the economy, massive damage to people's portfolios, massive damage to emotions, and massive panic by the central banks. So right now, think about it. Let's say you're an investor. Most aspects of your life are not doing that great. We've got a couple large corporate CEOs that subscribe to our reports and tell me privately that, when they really measure the real value of their company's output and profits and so forth, factoring in the degradation of the dollar, the real value.
The inflation, you mean? Yeah.
Yeah, the real inflation, not the baloney CPI or producer price, but the degradation in the money unit, doubling in supply every year, every decade, and even more so in the last 15 years. Their companies aren't doing that great in real terms, okay? Yeah, nominal numbers might look good on paper. This is kind of bullshit people look at. When you break the stock market, that's the one positive in everybody's life right now. You're a retired person, a couple $100 grand in your retirement account. That's the only area you're smiling about. If all of a sudden that retirement account dropped 20%, doesn't have to crash 35, suddenly sheds 20% in the first 6 months of the bear market or something. Then you've got pain in all aspects of your life, and the joy is gone. And it'll happen pretty quickly if it happens, and we think it's going to happen. Well, that creates emotion. And right now, the only reason you don't have a gushing of negative emotion is that silly drugged-up market. And when it breaks the drug control that the Fed has injected into it for 15 years, that's when emotion comes into markets, more so than we've seen. Right now, there's no emotion driving gold. There's emotion driving the stock market. You break that, and reality will change. Remember 2007? There was no big negative emotion. It wasn't until you got into about late 2008 suddenly had emotion. And all during that time, gold trended up with an exception of like one bad month in there, and et cetera. You get the point.
Yeah.
And that's when the central bank goes berserk. Doesn't help the stock market anymore, but it does flow somewhere else. All that liquidity goes somewhere, and we know where it's gone.
Okay. Alrighty. So the market here, basically in summarization, the market is of gold and silver is so small, and the equity market is so large, it doesn't take a whole lot of it to move in there to send silver to over 50 and to, quadruple gold here. And okay, you basically hit Mark John's, Tom's, Green Lanterns question, even Andy's. Okay, MK wants to know, Mr. Oliver, your opinion on countries or emerging markets in the new Cold War between the U.S. and China?
Well, I won't try to venture too much. It's just a fundamental thing. But one is technical. If you look at emerging market, EEM, for example, the ETF of the emerging markets, it's like 25% or so China stocks at all. So it's heavily weighted to China. Okay. Look at the China Shanghai Index, composite index. It's trading at less than double the price it was at its 2009 bear low, coincident with the U.S. market, bear low. Okay, it's gone up since then. It's been at much higher levels, but right now it's trading at less than double where it was in 2009. You look at the emerging markets, the broad basket. It's not a bubble like the U.S. market. Yes, it might trend down with the U.S. market. And some of the markets within emerging, what we call India, let's say, not the Nikkei. Nikkei is not emerging market, but those two indexes, Nikkei, but especially the Sensex, look very vulnerable to a crash like dementia, like ours do. They do have bubble attributes in terms of multiples, duration. But in general, the emerging markets as a broad category, especially China, do not have the attributes of a bubble. They could go into a bear. And already Shanghai, we know, has been drifting lower over the last couple of years in legs. And despite the government coming in trying to, stimulate it back up, we know that ultimately doesn't pan out. But they're not a bubble. So if I were to say, somebody says, well, I'm only going to be in the stock market, okay, and I'll go global, I would say, okay, then the thing to do at the appropriate point, it may be very soon, be short the S&P, be long EEM, equal amounts of money, spread position, long to the world, short the U.S., and you don't mind if there's a bear market.
This is the EEM
It is-
here. Yeah.
Well, yeah, look at EEM. Look how boring.
Yeah.
Look what it's done since 2009 low. Yeah, you're off that low back in 2009, but you're double.
Yeah.
Okay. S&P's eightfold, ninefold. NASDAQ's 18-fold.
Yeah.
So yeah, you want to go down? Yeah, you can break down. So the way to play that is not net long emerging markets, but maybe, own all the emerging market ETFs you want. Balance it with the equal amount of short S&P. Market neutral, global market neutral. So that would be our technical suggestion for somebody who wants to be in emerging markets. I don't think they'll trend up if we break down, but I don't think they'll collapse.
But they probably won't fall as far as
No.
as ours. Okay.
And as far as the Cold War, quote unquote, I know that that's been popular notion for the past couple of decades, particularly in the last 4 years, that China is aggressor and, et cetera, et cetera. But my bias is I tend to think that the party hierarchy is a lot of young men. They're not old Maoists anymore, okay? And when Deng Xiaoping came in the late 80s, he made a major change in China. He rejected Maoism. They used to have, communal agriculture, and therefore they had constant deficits of growth of food, okay? And he privatized the agricultural markets. Suddenly they were producing what they needed. Then they privatized this, then they privatized that. Yes, under Xi, we're back to an attempt, politically at least, not necessarily economically, to control the country from above. But economically speaking, it's still largely privatized. And a lot of the guys high up in the government don't particularly want a war. They buy and sell goods, particularly sell goods overseas to, Europe, US, so forth. They don't want to go to a war to collapse their companies. Okay? Okay. So you got a leader up there who's a dictator. Okay? Now, to the extent that and he executes people. We still know they do that stuff. But in terms of actually day-to-day control over the economy, that changed in the 1980s, and they've never really fully gone back to true Maoism. Yes, you've risen a dictator who's got, 6 years? I don't know how much he's got left in his term. It was a year ago. I think he resumed it. But there's a point at which if he jeopardized the viability of these companies and these members of the Communist Party hierarchy, we're not all politicos. A lot of these are corporate people or influenced by corporate people. He might be escorted out of office. Now, look back, for example, at the riots we had in China in recent months over the lockdown,
Mm-hmm.
COVID lockdown and so forth. The public rose up in the streets, okay? He replied immediately, canceled the military rule of the street corners. You can't come out of your apartment overnight. Was he influenced by the riots? Maybe. But I'll bet he was influenced by Communist Party hierarchy. He said, listen, you're going to destabilize the whole thing. Cut this out. Yeah, you could stay in power, but don't do that kind of stuff. Okay, so I'm arguing that I suspect when Trump does come in, we're going to have trade wars with him, but I don't think we're going to have a real war with them. They don't want one. And Putin certainly doesn't want one, because the assumption that he could invade Europe is the silliest notion I've ever heard of. He could barely invade Ukraine. And after 2-3 years of bloodshed on his part, massive bloodshed, he's barely gained some ground among some Ukrainians who actually are sympathetic to Russia in the first place. That's a truism, by the way, that part of Ukraine. Anyway, so yeah, I don't think there's going to be a world war. A trade war? Yeah. Okay. But that's the scale on which the war will occur. And that may be, who knows, maybe the trade war will dissolve itself over time because it proves to be disadvantageous on both sides. But that's the level where we're going, not a real war. I don't think the party hierarchy would like that.
Okay. I got a technical analyst question here. Nick is asking about an indicator on TradingView called momentum structure. Did you have anything?
I didn't even know it existed.
Okay.
Well, I know I wouldn't have sued him, but we invented that, and we called it momentum structural analysis in 1992. Okay. Basically, most of our methodology was developed before then, and it's changed only a bit over the decades. We've added a few nuances here and there, subtleties, but not really changed the basic concept. And to the extent that I read that sentence that you sent me, the question, it sounds like they were trying to copy what we did, but we didn't sue. I didn't even know they did it. I'm glad they canceled it. They probably don't know how to even interpret it, even if they can plot it. Okay. There's a lot of nuances involved. But it's interesting they tried to, because most of what we call momentum indicators, they've been around for a long time, RSI, MACD. We've always called them wet noodle indicators, meaning, yeah, they have some momentum relevance, but when you look at them, they literally look like a wet noodle, okay?
Yeah.
They don't always have great structure as such. We plot most of our momentum charts in bar format where you can see structure, triple bottom breakouts, 4-point, 10-point uptrend lines, and so forth, where, price doesn't have the line, but momentum has this line. So we look for structure, not for loop-de-loops. We pay attention to similar tools. We've created our own, for instance, Bollinger Bands, which is a price-based band measure. We've done that even before those came out, using standard deviation bands of our momentum readings, not of price.
Oh, interesting. Okay.
So we have similar band metrics on daily, weekly, monthly oscillators, but they're not derived from price bands. They're derived from our momentum readings. And we've been doing that for decades. So, yeah, it's interesting that somebody did that,
Yeah, it is. Okay. Let's see. We hit Keystone's question on S&P. Hit Jake's question. Okay, last question here. Would you lump PGMs? Would you lump the platinum group metals into the monetary metals category? Do you think more of those as like industrial metals?
No, there's times in the past when people remember platinum did better than gold and moved with gold. Okay, not so. Okay, anymore. It wasn't really a reality then. If you look at a Bloomberg commodity index chart, just get stupid, look at a price chart. Go back to 2020 lows when Bloomberg was under 60. Okay, went up to 140. Platinum moved too. Did platinum go up when gold went up from 2000 to 2020? No. It went up when the Bloomberg went up from 2020 to 2022. And then if you look at platinum compared after that 22 surge in the Bloomberg Commodity Index, gold during that time was in a range. Bloomberg had a major explosion. In fact, we timed it and called it a commodity explosion coming. Price then was 70 in October of 2020. It doubled. It went to 140, Bloomberg. By the way, which is still cheap historically for the Bloomberg. Then you had a correction. And by the way, the Bloomberg Commodity Index, quote, commodity inflation, if you want to call it that, peaked 1 month after the war began. Government likes to blame the commodity price increase that we saw delayed in reality in the consumer prices and so forth on the war. Had nothing to do with it. Commodities are already doubled and peaked right after the war. But anyway, platinum is very much reflective of the Bloomberg commodity category, not gold.
Okay. Oh, I just realized I wasn't sharing my screen. Okay, here we go. So this is the one you're talking about, right? Bloomberg Commodity Index. I got the.
Yeah, you see that low back in late 2020?
Yeah.
Gold had already doubled in price between its 2015 low. Look over to your left, see that other low in Bloomberg? Yeah. It went down between 2015 and 2020. Gold doubled in that same span of time. Gold went from 1,050 to 2,070. 2020. Bloomberg went down. Now, when gold was in its range, Bloomberg exploded.
Mm-hmm.
No correlation at all to gold. Okay.
Okay.
Now, there have been times in the past, late 70s, for example, where the CRB index of commodities preceding Bloomberg did go up with gold. Stock market was a wasteland then. Commodities exploded, gold exploded even more into that 1980 peak. Commodities did go up with gold then. That was one of the times. We see this Bloomberg chart, the action you see month to the month there. You go back a year, you've been sideways.
Mm-hmm. Yeah.
Basically on top of what had been the top of the prior range between 2017 and 18. We think that is, in fact, a base. And our momentum metrics say right now you're 97 something, right? Okay. You go up about 5 points above here and you're going to take off again.
Okay.
Spring next quarter. We've got a quarterly momentum breakout pending. Handful of percentage points. You go back up even near the top of the recent action.
Yeah.
You're going to blow that stuff out. And you're going to go back up again. At that point, Bloomberg is likely to then re-engage in a way that is coincident with gold. Not now, but it has not been for the last couple of years. It's been totally inverse. At that point, platinum will then suddenly move with the Bloomberg and look like it's moving with gold. Don't confuse the issue. Platinum is moving with the commodity complex.
Okay. Okay.
It's not a monetary metal. It's a precious metal. So when we talk about gold and silver, we use the word monetary metal. A lot of people use the word precious. That includes platinum. We don't do that. Don't agree.
Okay. Okay. Do you see it following a lot with, I mean, a big demand for platinum and palladium is the catalytic converter.
Yeah.
Do you see it maybe getting hit in this recession?
Well, no, it's already been hit. Look at palladium. It had the hell kicked out of it. You know, I mean, it's collapsed. And our view of palladium is it's basing. So regardless of, quote, economic downturn, that notion doesn't really work. Even with Dr. Copper, you know, they like that phrase, Dr. Copper, reflective of the economy. Okay. It doesn't. Plenty of times in the past, we've had recessions, copper goes up. Plenty of times in the past, stock market goes up, copper goes down. Okay. And we think copper is poised, like the Bloomberg, to advance again. It's not going to match gold. Bloomberg upside will not match gold, but it could be coincident. And also think within the stock market, forget the raw commodities themselves, within the stock market, it's going to be favorable going forward when the stock market breaks down to continue to own energy stocks, but probably shift your emphasis over to ag-related.
Oh, okay.
Agricultural-related companies also, there's an ETF called MOO, which has a lot of companies that are involved in agricultural-related products or services. And the fertilizer companies would be a place to look as well.
Nutrien, ones like that.
And they've all been beat down, you know, and so have the grains. The grains look ripe to possibly, our guess is probably the next advance in the commodity complex will be led on a performance basis by the grain complex.
Okay. Okay. So wheat would fall in that category.
Wheat, corn, beans, and markets and stocks that are related to the seed production, fertilizers, equipment, and so forth, despite a downturn in the stock market. So again, you want a spread? I would buy ag-related stocks. Be short the S&P. I bet you make money on both sides.
Yeah. This is a little off topic and one that was not written down, but you brought up copper. Have you looked at the Sprott Physical Copper Trust? It's trading at a north of 20% discount right now. I feel like there may be an arbitrage right there to just play a kind of a quick.
I don't have an opinion on that. I own Sprott Trust in silver and gold personally. We mentioned it, or a disclaimer when we put out reports. I'm not in the copper ETF. He's gone. I'm sure any relationship between his fund and copper, if it's distorted or discounted, will come back to reality, and it will reflect whatever copper does. If the copper goes up 100%, it'll go up 100%. Okay, so I wouldn't be concerned about any near-term seeming deviation. I mean, it's raw versus raw. Okay. Robert Rogers will put it back in line if it's out of line. Okay.
Okay. So we could have a 20%. I've basically been piling into this thing, hoping that
that's, you know, and I've seen that back in my early days and with the chairman of the COMEX, who was head of Hutton's division. I remember times when he would ship silver bullion from, this would be like a 75, from the New York bullion, COMEX, over to Chicago. They traded silver futures there too, because there was a several penny deviation.
Oh,
And the transportation cost of actually moving it per ounce didn't eat into that deviation by much, and therefore he would arbitrage it by shipping it via Brinks truck and actually make a locked-in guaranteed trade, So that same reality exists for this situation.
okay.
If in fact the Sprott Trust is discounted to reality, it ultimately won't be, because arbitrageurs will capture that difference.
Okay. So yeah, I played that one with the Sprott Physical Uranium Trust for the last 3 years. Talked about it on my show. I can't believe it still works, but it does. And now I see an even greater one. One of our listeners brought it up on the Copper Trust, and I'm like, oh my God. The last I saw it was at 23 or 24% discount. I'm like, well, this shouldn't last forever.
Well, yeah, no, the reality will come back as people who exploit it,
Yeah. Okay. There's not, just more guys like me. And
It's a low risk trade, if you know what I mean. It's physical versus physical.
Yeah. Okay. Okay. Awesome. Well, Michael, thank you very much. This is a real pleasure. I'd love to have you back on the show. Any closing thoughts? Anything I should have asked? If people want to get a hold of you and follow your work, how can they do so?
Oh, yeah, I think we covered it all. No, the main point that we're making for the last several months is, if you're in gold and silver as an investor, not an in and out trader, that's a different reality. That's true with any marketing, in and out trade. Don't be panicked by the sell-offs. Look at the context. Even look at that silly price chart we sent out a while ago. Even it is, there are drops, but is it going up? Yes, it's going up. Okay. From an investment grade point of view. The thing that's going to kick it into gear is something that will panic the central banks, and that is the break in their stock markets, which will precipitate a sharp collapse in the data points they look at. That's always been the case. The data points don't collapse before the market does. They follow stock market drops. So all these data points, people like to say, oh, things are looking good. They'll go dark so fast, it'll make your head spin. And the central banks, not just our central bank, have proven their record. And they will go full throttle, meaning monetary degradation in various ways, forms, and policies. Gold lives off that.
Okay. Embrace it. Awesome. Well, thank you very much, Michael. We will put your links down in the show notes for anyone that wants to follow you. Real pleasure. Thanks again for coming on the show.
Thank you.
Yes. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.